This time I have a brand new talk that I have never given before. So it's a first time I'm giving this, which is exciting for me. So, but hopefully it'll go over okay on your end, and everyone will like it as well. So anyway, a few thousand years ago, we were told about Moses going to the top of the mountain and then coming back with the commandments, the 10 commandments. And that story is slightly off. So, I have a lot of conversations with God, and in one of my conversations, he said that, Mohnish, when Moses was coming down the mountain, he dropped the tablets and they shattered into many different pieces. And so my commandments were lost, but he felt really bad, and humanity was expecting these commandments, so he made them up. And we've never had the real commandment. So he gave me the real commandments to usher onto the world through Arvind's BC class. And so that's what I'm going to try to do. And so God also said that he really wanted to focus the commandments on investment managers and not humanity. And unfortunately, Moses kind of broadened the scope of the task he had been given. And so these are the commandments for investment managers. And Moses was right. They're exactly 10 commandments. So he got that part correct. But anyway, the first commandment. So I don't know how long these are going to take to go through. So I'll try to speed them along so that we have enough time for Q&A and such. And certainly if the flock is looking for more clarity on one or more commandments, we can certainly do that during the Q&A. So anyway, the first commandment is thou shalt not skim off the top. And what the Lord means by that is that, one of the things with all these commandments is that the reason they are being presented is that most participants in the investment management business violate them, and they are sinners. And so we are trying to kind of improve the lot, if you will. So skimming off the top basically is setting up an investment operation where you're either taking, some percentage of fees as a fixed fee, and in the case of hedge funds, they're usually taking 1 or 2% of the top, and they're adding performance fees on top. And two of the original practitioners, Warren Buffett, Charlie Munger, they practice the art with no fees off the top. So Buffett had, I think, 0.625 once he merged all his partnerships, I think in 1962, where he took no fees off the top. And Charlie, I think, had a third, I think 1/3 above zero is my belief. I think that's what he did. But of course, that was a kind of specialist operation, a little different operation that he was running, and very little capital. But the bottom line is that both Buffett and Munger have said that if you're in the investment management business, what should have already happened before you set up your own shop or started managing other people's money is practice the art with your own limited assets. And if you did well with those assets, then the power of compounding is such that even a small amount of money becomes quite significant after a few years. I mean, if you're compounding at anything north of 15, 20, 25%, which you should be able to do on small amounts of capital, I mean, your money will be doubling every kind of 4 to 7 years type deal, and so even a small amount becomes fairly large in a few years, um, which gives you the ability to in effect uh, live off that base while the assets are growing. So anyway, that's the first commandment. The second commandment, thou shalt not have an investment team. So again, you know, investment management is not a team sport. It's really designed to be an individual pursuit. And an investing team is in many ways an oxymoron. And one of the there are many reasons why it's an oxymoron, but one of the basic reasons is that any two humans are going to have differing circles of competence. And so if I were to have, for example, an analyst on my team, and that analyst was very bright, and he or she came up with some investment ideas, I may reject them simply because I have a different circle of competence, and so which is really not doing justice to the analyst, if you will. And the second is that we don't need that many stocks in our portfolio, and so in a year we have plenty of time to research many stocks and to find 2, 3, or 4 of them that that kind of fit the bill, if you will. So they shouldn't. And the other thing is the investment analysis process is really the fun part of the job. So you really don't want to be delegating the fun part, because I wouldn't know what you'd be doing then if you weren't kind of analyzing investments. That's the most fun part. Then the third commandment, thou shalt accept that thou shalt be wrong at least 1/3 of the time. And some of these commandments leaked out from God over the years, and this comes from John Templeton, and basically the investment process is one where we are extrapolating, or we are trying to extrapolate the future of a business, or the future of many businesses. And by definition, that is a very inexact science. There are a multitude of factors that are going to affect every business into the future, and especially when we're trying to forecast or figure out what happens to a business 5 years from now or 10 years from now. It is an exercise fraught with difficulties, and definitely fraught with a high error rate. And so basically, if I were to pick, or let's say my current portfolio, if 10 stocks made up most of the portfolio, there are probably at least 4 of them that will not behave in the future in the way I expected them to behave when I made the investment. So it doesn't mean that 40% of the time I will lose money. What will happen is that at least 40% of the time I will either not make as much money as I thought, or I might lose money on some investments, or they might flatline, or they might even do better, far better than I thought. All of the above, and so this is an exercise in humility in terms of managing investments, and one has to always accept the fact that the future trajectory of businesses is and predicting that trajectory is at best an inexact science. And so we have to be kind of humble enough to accept the fact that even our highest conviction ideas may or may not get to where we expect to get them to. Then we get to commandment number 4. Thou shalt look for hidden PE of 1 stocks. And so, here's the way the world works. So maybe there are around, let's say, 50,000 publicly traded companies globally. And let's say I set up a screen which said I want to look at all companies that trade at 40 times earnings or less. The odds are I'd have kind of tens of thousands of businesses that would fit that screen. If then I change that to a PE of 30, I'd still have, several thousand businesses. PE of 20, still several thousand. PE of 10, still maybe, north of 1,000, maybe well above that. And as I keep tightening that noose, to PE of 5, PE of 3, PE of 1, there will still be some businesses that will slip through. Now, those are the non-hidden PE of 1s. But what we want to look for is the hidden PE of 1s, which means they are a PE of 1, but they don't show up as such on a screen. So, for example, and they can be a PE of 1 based on future earnings. They may not be a PE of 1 on today's earnings. I mean, in 2012, when I invested in Fiat Chrysler, it was trading at less than $5 a share, and the company had forecasted that in a few years, actually 2018, that they would make about $5 a share. And actually, as we are coming into 2018, they spun off Ferrari. But if I include the whole pie, including Ferrari, they exceeded that number. So what we paid in 2012, PE of 1, materialized in 2018, and so the end result is that investment went up 7 or 8x in that period. So generally speaking, when you do PE of 1s, in general, good things happen to you. And another stock I think I'd mentioned in your class, Arvind, a few years back was IPSCO. It was a steel company. And at the time I was investing in IPSCO, I think it was 2004 or thereabouts, 2004, 2005. And IPSCO was trading, if you just screened it, it was trading at 3 times earnings. But 1/3 of the market cap was in cash. And so if you kind of adjust it for the cash, because they were trading at 2 times earnings, and the earnings in the next 2 years with the company's own guidance and such was what the company expected to make in cash flows in the next 2 years. And so basically you had 1/3 in cash and in the next 2 years earnings coming out, and there was absolutely no visibility beyond the 2 years. So this was a very cyclical business. It was possible that after 2 years, earnings would just fall off a cliff. But my thinking then was that if we held the stock for 2 years, we got all our money back. And at that point, I just wanted to see what the stock would trade at. It had to trade for something because it had all these huge plants and infrastructure and everything else. And so what happened in that case is a year after I bought the stock, the company announced they had 1 more year of visibility and earnings were going to continue the way they had been happening, which means now we had, in effect, 3 years of visibility. So we were in the black. And then as we were getting close to 2 years, someone came and bought the company. And we ended up with about a 4x return on the initial purchase in less than 2 years. And so anyway, the PE ones, what I noticed is that in the last 19 years or so that I've been running Pabrai funds, it's happened at least 6 or 7 times that we found PE ones like Fiat Chrysler or like IPSCO. Very early on, I'd invested in Stewart Enterprises, which was in the funeral services business. That actually was sitting at a PE of 2 in Value Line. I opened up Value Line as I do every week. I always look for the PE of 1s in Value Line. Usually they're not there, but you can find PE of 2s quite commonly. Usually those are businesses that are good to avoid. But every once in a while, there is a gem that shows up. So, for example, the reason I was kind of interested in Stewart Enterprises when it showed up is that they're in the business of burying dead people. And they're in the funeral services business. And one thing I had read a long time ago about the funeral services business is that out of all the business SIC codes, industry categorizations, funeral homes have the lowest rate of business failure. So if you look at across industries, across a number of any industry, the lowest rate of business failure is funeral homes. And the reason for that actually becomes obvious if you think about it. So first of all, no one in this classroom, all of you gifted people, is planning to go into the funeral services business. I can almost bet on that. There are no 22-year-olds I know of who say, you know what, I think I'm going to go into the funeral services business because it has the lowest rate of failure. It's such an awesome business. That's what I'm going to do. This doesn't happen. So first of all, the people entering the business are few and far between. And then the second is that when your aunt or uncle who you love so much passes away, you don't go about seeking the low bid to have their last rites done. You might at the most reach out to, typically you'll reach out to the place that ideally your family has been using for many generations, and hopefully get it done that way. But even if that's not the case, you'll try to reach out to some neighborhood funeral services operation, and whatever they tell you, you're not going to start negotiating on the phone, and you're probably not even making 5 calls to get the lowest bid. So this is not a business where you're going to seek out, unless you hated that particular relative, you're not going to particularly seek out a low bid. And of course, you've got all the upsells with air-conditioned coffins and everything else in between to make you feel really good. And anyway, so basically, the hidden PEO ones is really good for your health and your financial health. I mean, and so looking for them is a great exercise. And in fact, I just got back from Istanbul last night, and I think it was only PEO ones that I visited. I was swimming in PEO ones. It was quite the orgasmic experience. Anyway, so that's commandment number 4, to go hunting for PEO ones. Then commandment 5, thou shalt never use Excel. So this actually kind of goes hand in hand with commandment 4, and even it goes hand in hand with not having an investment team. But basically, if you can't figure it out in your head, so the investment process is really quite simple. You know, if a company, let's say, has a market cap of $1 billion, and let's say it's trading at 20 times earnings, so trailing earnings are 50 million, for example, and let's assume those are owner earnings that you can withdraw as dividends and such to keep it simple. Well, the the billion-dollar market cap, uh, whether that is undervalued or overvalued or fairly valued, one can only uh, make a judgment of that if one can figure out the cash flows that are coming out of the business over the next, I mean, it's from now to Judgment Day, but you can approximate that to be now, between now and the next 10 or 20 years, because after that, it really doesn't matter. The terminal values become too small. And so if this business is trading at 20 times earnings, and if earnings are expected to grow at, let's say, 10 or 15% a year, then what you can do, and if you have a very high degree of conviction that that 10 or 15% rate of earnings growth is sustainable for a very long period of time, maybe 15 or 20 years, then you can actually, run the math. You can say, okay, year one, the earnings are 50 million, year two, the earnings are 60 million, year three, the earnings are, I mean, if you're growing at 20%, but if you're growing at 10%, 50, 55, 60 and a half, 66 and change, and just keep going from there. And then you have to discount each of those by your expected rate of return. So for example, if I want a 20% rate of return on this investment, I have to start discounting those future cash flows at that 20% rate, and then I have to, because if I'm getting 55 million a year from now, my cost of capital is 20 million. So that 55 million is really worth like 44 million because I'm not getting it today. And so as I discount all those future cash flows and run those numbers, it will be very hard to get to 1 billion because the earnings are growing at 10%, but your expectation is 20. So it will be a kind of a declining future stream. Every year will be less than 50 million, in effect, and in present value. And so the math just doesn't work. Now, if you reduce your return expectations to something like 8%, it may work. If you said, I only want a 7 or 8% return, that may work. But even then, there are some heroic assumptions. And we already saw what Templeton said, that you're going to be wrong 1/3 of the time, and capitalism is brutal. So unless this is a fast-growing funeral services operation, it's not going to be there clocking 20% or 10% a year for 15 years because it's just difficult in business to have that much of a runway without people coming in to take your moat away. And so the thing is that how do we get around that? Well, the way we get around that is by making the math really simple. And the way we make the math really simple is we go back to PE of 1. And when we go back to PE of 1, all the math becomes really easy. Because then if I want to make like 25% a year, well, I get my money back in 2 or 3 years, and I still have the business, is still producing cash, and you'll find that it'll deliver that return. And it might deliver that return at a PE of 2 as well, or 3 as well. And but once you start getting to high single digits or double digits, generally speaking, the math doesn't work so well. It's a lot harder to make it work. And I think, like, for example, if we were to look at, I think like a simple case is, if we look at a business like Apple. So let's take a simple case that Apple is worth exactly $1 trillion. I haven't been tracking it. I think it's a little bit above that. But let's say it's exactly $1 trillion. And let's say I want I'm an unreasonable guy, and I want a like 25% annual return on my capital, for example. Arvind knows my license plate says compound 26. Um, so if I want a 25 or 26% return on my money, the first year that business has to produce 260 billion in owner earnings. And I don't think that's what Apple is producing right now. I'm not quite sure. Maybe someone in the class knows, or maybe you can look it up, Arvind. Arvind, what is the trailing PE of Apple, approximately? Is it like 10 times or something?
I think it's higher than that, but I can get it for you.
Yeah. So, but let's be generous. Let's say it's trading at 10 times earnings. Let's say that what it's saying is that Apple's making 100 billion a year. Okay, so I need 260 billion for my 26% or 25%. It's making, let's say, 100 billion, and then a year from now, let's say it's 115 billion. Let's say I'll give it that, they've got a rocking market position. Earnings grow by 15%, it goes to 115 billion. And let's say for the next 10 years, it's compounding at 15%. Even with 100 billion in earnings compounding at 15% for 10 years, which means that in the 10th year, it will be 400 billion, because in 5 years, it'll double to 200 billion, and 10 years, it'll double again to 400 billion. That 10th year, 400 billion is not worth 260 billion today. Because when I discount that at the 26% rate, it will go down below 100, because it's just it needs to be doubling every 3 years and such. So anyway, the bottom line is that if your return expectations are something like 7% a year, and Apple is growing at 6-7% a year or something, it may work. So one of the things that you can do with just playing with these 2-3 numbers, which is market cap, current earnings, and what you expect earnings to grow at, and of course, I think a lot of people would have difficulty getting to assumptions that Apple will grow 15% a year, bottom line, for 10 or 15 years without any hiccups. That may happen. It's a very dominant company in a dominant position, but we've seen a lot of past dominant companies have problems in these areas. So the thing is that when I look at something like Apple, it doesn't even take a femtosecond to take a pass. And now, if we had Apple at like something like 3 times earnings, like $1 trillion market cap, making 350 billion a year, growing at whatever, 15% or something, even someone like me might get interested. So the thing is that a PE of 3 on Apple might get me excited, and a PE of 10, not quite as exciting. And
Mohnish, my TA is saying that the PE is closer to 20 times, so you're going to be a lot less excited.
Ouch, man, that's so hard. And so the thing is that so if you run this same math, starting at 50 billion, which is where trailing earnings are, and even if you take heroic assumptions of 20% growth, unabated, I still can't get to the promised land. As you know, with the commandments, I've been to the promised land, but I can't get to the promised land with it. So that was the fifth commandment: thou shalt never use Excel. And as you saw with all the math we did, we didn't even need a calculator. Forget Excel. We just did it in our heads. So there is no need for Excel. And if you find yourself reaching for Excel, what that means is you take a pass. it's an automatic pass the moment you feel, oh, I need Excel to figure this out. If you need Excel, it means you need to take a pass. If you can't do the math on the fingers in one hand, you need to take a pass. If you're going to two hands, there's a problem. You need to be doing the math with one hand and no calculator and what's between your ears. That's it. Like I said, these are all things that Arvind will never talk to you about. It's only me and you that can talk about such things. Then commandment number 6, thou shalt always have a rope to climb out of the deepest well. So, in case some of you didn't understand that fully, let me try to decipher what the good Lord meant by commandment number 6. So, when I was growing up, my dad was an entrepreneur, and he was really good at starting a number of businesses with nothing, no capital, and he was really good at getting them to some scale. I mean, some of these would get up to north of 100 employees and such. I mean, they would move pretty quickly, but he was always very aggressive with his growth plans and leverage and such, and overly optimistic, and invariably these businesses would blow up. And so he went through a number of bankruptcies. So when I was growing up, and my parents were very bad kind of financial planners or savers. So as the business did, so did our household fortunes, if you will. So when the business was doing well, things were loose and going well at home. And when the business blew up, we didn't have money for rent. We didn't have money for groceries. We were, asking relatives to help us out, asking friends. And so it was a tough situation. And one time, I think when I was like about maybe 9 or 10 years old, and my father had gone bankrupt, he had this guy who was a astrologer show up to our house, our apartment, every Sunday. And this astrologer would have all these, orange robes with a bunch of marks on his forehead, with a bald head and all that. And he would have all these different charts, and he would tell my father about the future. And then my father would pay him, and then the guy would come the following week. And this was kind of a weekly thing going on. And I told my dad, after observing this for a few weeks, that, because my dad was an engineer, he was a very rational guy. And I said, you have to know that this person is just talking utter nonsense, And so my dad said to me that I am at the bottom of a well, and I need a rope to climb out of the well. And this orange robed guy is my rope, because when I pay him, he makes sure that he tells me that the future is great. Because he knows if he says that the future is not great, he's not coming back the following week. So every week when I have my session with him, he is telling me about these future businesses that I'm going to start and all this prosperity that's going to come. And I need something to climb out of the well that I'm in. And one of the things that surprised me repeatedly about my dad was that the ability to bounce back. I mean, I noticed as he got older that his bounce back was harder than it used to be when he was younger. I think it was just harder going through it over and over. But I was always very surprised at the quickness with which, as he was, putting one business, the last semblance of it going under, he was already kind of thinking about the next one and such. So in the investment business, we are going to have gyrations. And we're going to have periods when performance is great, and we're going to have periods when performance is not so great. And so, for example, in the financial crisis, 2008-09, Pabrai funds from the peak in June of 2007 to the bottom in March of 2009, the funds dropped between 65 and 70%. It's a huge drop. And you know, when I told you about commandment number 1, thou shalt not skim off the top. So basically, if my fund were worth, let's say, $600 million or thereabouts, let's say in June of 2007, basically by June of 2008, in order to collect a fee, it needed to be at least 636 million, 6% return, and then I get paid. Instead, the funds were below 200 million. So 600 million goes to 200 million. The base level required to earn a fee is 636 million. I am in a very deep well. And so I thought back to the guy in the orange robes. And unfortunately, I didn't have his email address. And I don't even know if he was alive then. He may have passed away probably. So I was looking for the guy in the orange robes, but he was nowhere to be found. So I said, I'm at the bottom of the well and I need a rope. I need a rope to pull me out. And what I did is I violated commandment number 5. I first sought the forgiveness of the Lord and said, in order to follow commandment number 6, I need to temporarily get a pass on commandment number 5. And after many years, I fired up Excel. And what I did is I took my portfolio and I put in prices for all the stocks that were in my portfolio at the end of 2010 and at the end of 2011. So I put my best guess as what these companies would be trading at the end of 2010 and then 2011. And of course, things had collapsed. I mean, there were things. I mean, there were a lot of bargains at that time. I mean, anything I was investing in went up several times after that. And when I looked at the numbers of the aggregate portfolio at the end of 2010 and at the end of 2011, it was well north of 600 million. Partially because I had control over what went into those cells. Just like the astrologer had control over what he was going to say the future was going to do. And, like we hear about Steve Jobs' distorted reality field. We need distorted reality to climb out of wells. And so what I did is, instead of focusing on the $200 million number in my mind, I focused on the 2010 or 2011 number when I was going to be in fee earning territory and life would be, great, happy days would be here again. And that actually worked. In fact, I still have the spreadsheet, and every once in a while, if I feel that we are in a well and we need to climb out, I'll always go back to that. And so I don't use Excel for doing investment analysis. I do use Excel to climb out of wells, and it works pretty well. So you always need, not only in investing but in life, a rope to climb out of deep wells. So it is a guarantee that both in investing and in life, you will find yourself in deep wells. Life would be quite boring if that didn't happen. So that's commandment number 6. And commandment number 7, thou shalt be singularly focused like Arjuna. And of course, no one knows Arjuna better than Arvind, because a few years back, Arvind sent me a nice painting, and the painting showed a guy with a bow firing at a target, and I think the guy was Arjuna in the painting. So anyway, there's an Indian epic which was written a few thousand years ago called the Mahabharata, and in the Mahabharata there is one of the heroes is this great warrior and archer called Arjuna. And when Arjun was being trained as an archer, uh, his teacher one day told all his students that he's going to have a practical test for them, and he basically set up a long pole, and at the end of the pole he put a fish, kind of a sculpture of a fish, and the fish had a tiny couple of blue eyes, small blue eyes. Then he put this pole in a kind of a pool of water, a tub of water, and he told his students that he wanted them to look at the water to see the reflection of the fish and the eye of the fish, and to shoot the eye out. So, and these were all kind of nobility, princes of different kingdoms. So the first prince steps up to take his test, and before he fires his bow, the teacher asks him, Dronacharya asked him, "What do you see?" He says, "Oh, I see the water, the pole, the fish." And so the guy says, "Okay, sit down, you're not ready for the test." And then the second prince stands up, and again the teacher asks him, "What do you see?" He says, "I can see the pole, I can see the fish, I can see the eye of the fish." So the guy tells them, "You're not ready to shoot, sit down." And one by one, the different princes stand up, tell their teacher what they see, and they're not allowed to shoot the bow. And finally, our hero Arjuna stands up, and he's asked what he sees, and he says that I can only see the center of the eye of the fish. And so Dronacharya tells him, "Fire at will," and of course he takes the eye out. And so one of the lessons we need to learn from Arjuna is that we need to be focused like him. So anytime we're looking at, and especially when we're looking at these PEO1 businesses, usually there's more than one cloud hanging on top of the business. There are many clouds. And also, there are always a lot of macro clouds. And also, even if there are no macro clouds, there are macro concerns. And what we need to do is we need to be like Arjuna. We need to focus on the business and only the business. And so to figure out the future of an economy is really hard. For me to figure out the future of even state of California is very hard. Or even the county I live in, just kind of what's going to happen. So those are really difficult questions. So we have to simplify the world. And one of the ways to simplify it is to be like Arjuna. You focus on the business and you don't focus on the noise. And one of the things I noticed when I was in Istanbul the last few days is there's a lot of noise. And if one can get past the noise and focus on the business and just consider the nuances of the business, things can become quite clear and quite obvious. So I did find a few things that I think we will pull the trigger on, but if I were to look at those, the macro situation, the country, or even the headwinds that the businesses are facing, there are significant headwinds. But if I'm buying at 20% of liquidation value, or at such a small fraction of future earnings that and like I said, these are fantastic assets. So focusing on the center of the eye of the fish is the name of the game. That's what we need to do. So do not get yourself distracted by looking at all kinds of macro things. I think you're best off ignoring all of them because anyway you can't predict them. Then commandment number 8. Commandment number 8 is thou shalt never short a stock. So I don't think we need to spend much time here, but that's pretty obvious. Is we don't need to figure out what's going to happen to Tesla. That's we don't need to go long and we don't need to go short. That just falls in the too hard pile. And so, like Tesla for me, the stock, not the car, is there for pure entertainment purposes, just to watch from the front row seats as opposed to being in the arena. So we just don't need to figure out exactly what's going to happen, and we don't need to go. So first of all, commandment number 3 is you're going to be wrong 1/3 of the time. I think with shorting, you're going to be wrong like 80% of the time. So both Buffett and Munger say that they've always been right on the stocks that they thought ought to be shorted, but they were always wrong on the timing. And the timing can get very painful. Also, the math is against you. Because the maximum you can make if you're right in a short position is a double. And we're not going for doubles. And the maximum you can lose is you can go bankrupt. So there's no point making bets where the highest upside is a double and the highest downside is that you're out of the game. So I shall go to my grave without ever having shorted a stock, and I think you should do the same. And then, commandment number 9 comes from Polonius. And even though Polonius came long after Moses did, he was the character in Hamlet. And Polonius said to his son, neither a lender nor a borrower be. And so I think Buffett's tweak on Polonius is neither a long-term lender nor a short-term borrower be. So basically, you don't want to introduce leverage into your life. I think that to finish first, you have to first finish, and we want to make sure that we get to play the game, and we get to play the game for a long time. So the key is to spend less than we earn, and put that difference in a compounding engine. If you're spending more than you're earning, then it's not a good thing. And I have a blog. Some of you might have visited the blog, but I'll put an ad in for my blog here. My blog is called Chai with Pabrai, and so if you ever feel like having a cup of tea with me, you can go to my blog. And one of the first posts I made in fact, one of the impetus to set up the blog was a guy named Mr. Money Mustache. Some of you, maybe you can raise your hands. How many of you have heard of Mr. Money Mustache? Just raise your hand if you ever heard of him. We have a few enlightened humans in the room, which is great. So Mr. Money Mustache is a good person that you should get familiar with. I always expect that I'm going to hear that Mr. Money Mustache got divorced because his wife can't deal with him. But I think he married Mrs. Money Mustache. And so I think she's even more gung-ho about his methods than he is. But anyway, Mr. Money Mustache, I think he's in his early 30s now. But he, at 22, he was a software engineer. And he decided that he was going to be retired at the age of 30. And he was going to be retired at the age of 30 not because he got some exit from some company, but he would retire at 30 being a software engineer, having just made a normal software engineer salary for 8 years. So he ran his life for 8 years. I mean, like, for example, Mr. Money Mustache would not be caught dead in a Starbucks. I mean, paying $4 for a coffee ain't happening. He's like more like 5 cents for a coffee. So I think he had like a 60% or 70% savings rate. So he has a car, but I think he consumes about 2 gallons of gas a year in that car, and his bike gets a lot of mileage. He's bikes everywhere, and he's a carpenter. I think he built most of his own house somewhere in the woods of Colorado, and anyway, I think it's worth going to his blog. I think you might have some difficulty with some of his methods, but if you even follow 1/3 of what he does, you'll be on a great path. So he carefully looked at every expense us humans have. He decided that the way the economy is set up, which is we take a bunch of loans when we get jobs, which is we buy a fancy car and have a loan and buy a fancy house, or have high rent and all that. That was all for the birds. He wasn't doing that. He took no debt. He drove a beater, I think, and basically he just looked at every line item that he had expenses with, and nothing was going to be spent. So anyway, and of course, now the funny thing is Mr. Money Mustache, through his blog, makes several $100,000 a year because his blog is so popular. And he's a little disappointed about that. He's kind of sad about it because he didn't want to kind of be making all this money. He wanted to prove that he can, live the way he does. So he claims at least that all that money is going to charity. So maybe it is, which is great. But he's a great example to follow, and first story on my blog amongst many other good stories. And then finally, commandment number 10 is thou shalt be a shameless cloner. So cloning is very good for your health. It's just there are many smart people who are great investors. In many cases, their portfolios are visible to us because it's required by law. And it's a great shortcut to look at what are the highest conviction ideas of some very smart people. And we have websites like Dataroma, for example, in the US, which is tracking a bunch of investors and telling you what their highest conviction bets are. And so I think cloning can be really good for your health. And that's the 10th and final commandment.